Our next panel explores the question of minority equity deals, a magic formula for the European economy, question mark. To oversee the debate, it's my great pleasure to introduce Brice Lyonnais, CEA of Isatis Capital.
So good afternoon, everyone. So I'm Brice Lyonnais. So I'm supposed to be the moderator this afternoon. So I'm glad to be here and talk about. I don't know if it's a magic issue, but at least it's a scope of investment we're in. So all the attendees are in, and that we find is a very attracting and still promising area to invest in. So we'll try to organize discussions around what are the interests of investing in minority equity deals, and also discuss about what's specific about this area, and probably since you have people who are covering Europe, you probably get some more insight about the differences between the different countries we're based in. So that's basically the idea of the discussion of today. So probably I will start the session by asking each and every member to introduce himself, tell him about who they are, about the company they're in, and trying to make it rather quick so that we have some time for discussions and then try to cover the different subjects I highlighted in the beginning of this presentation. Thank you very much. Please,
okay.
Please.
Yeah. Okay.
I'll be finishing the presentation.
Yeah, Brice, thank you very much. Hello everybody. It's a pleasure to be here. Jörg Oschin, KfW Capital. We are a subsidiary of KfW Banking Group, which is the world's largest development bank based in Germany. KfW Capital invests in European venture capital funds. We are one of the largest LPs in Europe in European venture capital funds. And we're building the VC ecosystem, also putting a strong emphasis on ESG, on the ESG topic. And that's about it.
Hi, I'm Grégoire Sainty. I'm the founder and the CEO of NextStage that I launched 20 years ago with Jean-David Haas, my partner. We were probably one of the first entrepreneur investor fund back 20 years ago, and we built the category of growth equity, which at that time was not at all fashionable trend, because everybody was focusing first until 2000 on venture capital, and after 2001 everybody was focusing on the buyout. And now we have 86 portfolio companies. We have a little over 7 billion euros under management directly and indirectly. And we have been in the top quartile for the last 10 years by investing along top-notch entrepreneurs, not managers, that's important, and helping them to build champions in the market categories.
Go ahead. Yeah,
Please.
Okay. Hello, I'm Eric Halverson. I'm one of the founders of Qualitas Group, based in Madrid. We're an alternative asset manager with over 4 billion in assets under management with 5 different business areas. We do direct investments in Spain, mostly minority investments with a joint venture with Banco Santander. We have a renewable energies team, which has significant assets throughout Europe in renewable energies. We have a fund of funds group, which I also lead up. And we have relationships with over 50 GPs, over 500 companies, a lot of which are minority investments. We have a real estate investment group, and we also have an impact investment fund. So that's us.
Hello, Julian Koh, my name. I'm with COI Partners, which is a German-based and Swiss-based private equity firm who is mainly investing in small and mid-cap companies around German-speaking countries mainly. We are also fairly sector agnostic and invest as well in minorities as well as in majority investments. And therefore, our current portfolio is approximately 2/3 minority investments and 1/3 majority investments. And what we do basically is we try to focus on investing together with entrepreneurs and focusing exactly on entrepreneurial spirit in all kind of sectors and helping exactly those to accelerate their growth.
Okay, so just to finish, so I'm Brice Lyonnais, as you already know. So I'm the CEO of a French-based company based in Paris, which is currently managing 450 million euro, and we focus on we do minorities just like you, minority and majority investments, so 2/3, 1/3. In French SMEs with a strong focus on growth and a strong focus also on IT, because it's basically more than half of what we do as far as investments are concerned. So we've been created 20 years ago and financed more than 120 companies so far. And our portfolio is now made of 35 companies. So it's all of them being SMEs and fast-growing SMEs. So that's who we are. Just to begin the discussions, I just wanted to say that even though LBO is very trendy, I don't know if it's minorities investment are magic, but at least they are very interesting. So probably I would ask Grégoire to describe why this area is interesting and what's really not trendy, at least attractive or magic, whatever.
Well, just to get you to smile, a long time ago, I used to work in a German-based company in Gütersloh, in Bertelsmann. And I learned the value of the Mittelstand companies, and it was obvious of two things. One is you have a lot of small and medium-sized companies who, more than the multinational companies, were able to, thanks to innovation and going global, were able to become the champions of their categories. The Bertelsmann, the Miller of the world, and so on. And clearly they were creating enormous amount of wealth. And there were a big number of them in Germany, in France, and all over Europe. Two, a lot of those entrepreneurs were not willing to give up majority control of those companies. And as a result, minority-based investment was the only way for them to envision a potential alliance with a strong alignment of interest with private equity investors, envisioning and ready to invest with no or very few leverage, and then on that basis, step by step, helping them, including with a patient capital approach, to invest. When you do so, you have to leverage some of the things that we learned at Next Stage in the US, which is to have a rendezvous clause, which is the buy or sell clause, where every 5 or 6 or 7 years, you make sure that you can meet together and decide whether you will exit or not. And if you do so, you make sure that your interests are fully aligned. And to conclude on that point, the beauty of that is threefold. One, you have the chance to do a much more bigger amount of primary deals. And primary deals it requires more work, but they are less expensive. The second thing is the universe is much, much, much bigger. And three, instead of focusing on managers, you focus on entrepreneurs. And entrepreneurs have skin in the game, and they have their down, but they have their vision, they have their strength. And if you capitalize and leverage well with strength, you create sometimes much more wealth. And we've seen over the last 5-10 years, growth equity, and I would like to emphasize something, where there's something dangerous in the market by stating that growth equity was investing in companies which were growing, but not necessarily making profit. We strongly believe at Next Stage that growth equity means investing in companies which are profitable company. And it makes a big difference. And if you do so, then you have a big chance to generate a kind of Mittelstand companies where we have so much to learn from our German colleagues.
Sure, exactly. So you mentioned that, well, you refer to Mittelstand, so it would be good to know exactly what is the German landscape so far, and probably also focus on the exit side of that kind of investment, because most of the time people believe that whenever you invest in minority investment, it's very hard to exit because you're a minor investor, you cannot trigger the way you want. But everything has to do with alignment, especially with the founders. So could you probably, Julian, tell us more about what's going on in Germany in that regard, and how the way you treat those subjects?
Sure. I find this argument fairly interesting. I heard it several times that minority interests might be illiquid and some people might have issues to exit. Then I always associate that with some kind of friends and family investments into a family-owned business who really stuck there with the owner. The way we do business is a bit different. So I also think this is essentially dependent on your business model and investment approach which you are driving. And key point to this topic, illiquidity, is that you need to understand who is your counterpart. And I mean, shareholders of family companies or family-owned companies are basically entrepreneurs, as Grégoire already said. These are different kind of people who you need to understand and to tackle properly. And these are not people who are managers of some kind of large cap companies. So what is the point there? These entrepreneurs have usually some emotional component to their company. Often their companies even have their names on top. And in the end, these entrepreneurs do not like to share economic benefits or even lose control over their company and their life work, kind of. And what we basically do, we try to tackle this issue, also the exit issue and the liquidity issue, through two pillars. And I think the first one I would like to start is in my opinion, the most important one is alignment of interests. Alignment of interests based on a common understanding, common ground, common vision, together with the entrepreneur at the very beginning of any process you start. Not just at the end, not to start negotiating past term sheets or after SPAs, even after entry. No, start at the beginning and try to build a trust basis together with the entrepreneur. This is the first thing. And in that point, we try to explain to entrepreneurs exactly what is our value add, because this is what he's interested in. He's not going to take an outside party, an investor, without really clearly understanding what the value add is. And we try to explain him we can be not just an entrepreneurial-minded investor, but also somebody who can build a bridge to exit in the end. And this is the first pillar. If you have that common understanding and the trust basis, you can go to the second part, which is basically ensuring everything that you can contractually enforce all this common ground and common understanding. And I think many people just do the mistake that they try to go first with the contractual basis and then try to argue why they do it like that, and they lose trust in that. And that's why many people have some kind of a misconception regarding minority interests, minority investments in family-owned businesses.
Yeah. So we are in a people business, so basically. So everything has to do with the people and making sure that you are very much aligned with your managers. So it's I think most of you have already emphasized that, but I couldn't agree more. It's exactly the way we work also within Isatis. So that's completely agree.
And just to add that one point, I mean, in the end, the contractual part or the legal part is not even the most sophisticated one. This is really just techniques. And you can really replicate kind of a majority shareholding structure into a minority shareholding, ensure all the rights, even as a minority shareholder. That's not an issue. But doing the step ahead, really gaining the trust of an entrepreneur, and really to try to explain him why it's reasonable to take an outside party in and to help him to exit in a couple of years and to make the company saleable, I would say, and to increase the probability of succession of the company is, I think, the most important part.
Okay, so hope we have demonstrated you that minority investments is is a large scope of opportunities, and it's liquid. So it's very important to emphasize that. But among also minority investments, so we do growth, just like Grégoire. Most of us invest in profitable companies, but where there are also investment made in the venture area, venture and growth area. So probably if it would be good, Jörg, if you could describe the recent landscape, because it's been very hectic these years in innovation in the venture world. There are some evolutions, but probably it would be nice if you could highlight what's going on in that space as well.
Yeah, please, happy to do so. I mean, KfW Capital is a minority investor in a double sense. First of all, we are an LP in funds, so we are a fund investor, and being a fund investor usually means that you're not taking the majority of the fund. So I mean, if you have 10% or 15% of a fund, then you're already a large LP. And the funds we invest in, the venture capital funds, they also do minority investments for very good reason. Julian and Greg just mentioned the topic alignment of interest. It's very important, and it's run by the founders, by the entrepreneurs. And at the very early stage, I mean, the shareholders want to ensure that the entrepreneurs have sufficient skin in the game and that they have sufficient cushion for the upcoming dilution. So minority investments, I think, are the only way to make successful investments on the venture side, because you're very much dependent on the entrepreneurs driving and building the business. What's going on was the question. I think on the venture side we're not isolated. I think the whole private market is affected by three large movements which are going on, and I think on the venture side and on the growth equity side there are slight for the years coming there are slight advantages ahead if you compare that to the other segments of the private markets, be it buyout, be it real estate, be it infrastructure or restructuring. So if we divide those two, make a dividing line between venture capital and the other sectors. So the first factor which drives the market is, I think, the increased interest environment, which we are, the increased interest rates. On the buyout side, they are hit double. First of all, the funds, when they do the acquisitions, they use leverage, and on the portfolio company level, they use also leverage in order to finance the business. So increased interest rates really, I think, hit the traditional private market segment in a double way. On the venture side, you don't use that leverage. Second, inflation. Think on the increased costs of raw materials, of half products, and also of energy hit heavily production companies. So the underlying portfolio companies of buyout funds. On the venture capital side, in contrast, you don't have that heavy production dependence and dependence on costs. I would rather argue that the increased energy costs and no availability of raw materials force the traditional companies to change their ways they produce and to use new technologies developed by the technology firms and the startups in order to use them, and this gives rather a tailwind to those technology firms. So I think there's a chance in the crisis. And third, a very important change which affects the whole private market sector is the whole geopolitical situation. I don't only mean Russia, Ukraine, also China, Taiwan, and so on. The traditional companies are hit also in a double whammy. First of all, the supply chains, some of them are broken up, and also the sales markets, they also are not any longer available to traditional companies. And on the tech side, I mean, those companies are not that established yet. They don't have that established supply chains, and not those. They are not so much internationally active, and so I think this will also affect the venture capital side to a lesser extent. So to sum it up, I would say going forward, there's an opportunity in the current crisis, and we still have also COVID around, and we have other things, political instability and so on, especially in Europe. But on a relative level, I think I would rather draw a more optimistic picture for tech venture than on the traditional buyout side.
So what we could say actually is that minority investments are here to stay, even though the economic outlook is weaker. There are more uncertainties, but activity is still there. So there will still be some opportunities, new deals being made with less leverage. And so this, well, for an LP who's considering investing in this area, it's still an area that's going to be here to stay in the coming years. So it's probably Eric, would be good for you if you could describe us about the European landscape, because you have a vision. So we know more about our domestic countries, but if you could describe us what's going on throughout Europe from your window, because you have.
Well, I mean, from an LP perspective, I guess the most important question is, what makes more sense from a return perspective, minority or majority? Well, what are the best types of deals, majority or minority? It's a pretty interesting question. And fortunately, from a fund of funds perspective, we're following 4,000 funds, we're following 10,000 transactions historically. So we have all this data, we can kind of put it all together, cross the data and find out what kinds of deals make more sense, majority or minority. Well, if you look at the data, first of all, there's a whole bunch of public studies that have shown that, let's say before 2007, minority deals lagged majority deals in terms of return. And after 2007, there's been kind of a convergence. So that's kind of the public data. There was a study by Morgan Stanley that suggested that. Our own data suggests that there is a positive relationship between the percentage that the GP owns of a company and the return. And that's both in terms of IRR as well as return on capital. What is that relationship? So there's a positive relationship. The more I own of a company, the higher likelihood that I will have a higher return. So there's a positive relationship. How much of the returns are explained by that relationship? About 10%. So 10%. So that means that there's 90% of the return that has nothing to do with whether it's a minority or a majority stake in a company. But if I could choose, why wouldn't I want a majority? In a majority, I get to make the decisions. I don't have to listen to somebody else. I control the exit. I don't have to get drag along rights, tag along rights. I control everything. So why wouldn't I want the majority? Except the only thing I could imagine is maybe you have a portfolio strategy and you don't want to make decisions because you're investing in 50 companies with minority stakes and you just want to take a minority stake, but you've got a problem at the exit. But otherwise, I think we would all want to have the majority stake. So why would you want a minority stake? Well, you would want a minority stake because you can't get a majority. And you can't get a majority because there's some factor that's attractive about this company that enables you to decide that you want to take a minority stake. What kind of factor would be more important than whether it's a majority or minority? Well, the price. That's a key factor. The sector, there's a lot of sectors where you just can't get a majority stake in that particular sector. Maybe in the geography, the growth rate, a fast-growing company with a strong entrepreneur, it's very likely that you just won't get a majority stake. So why do minority investments? Because you can't get the majority. Does that mean that they're worse investments? Not necessarily. Only 10% of the explanation is according to the shareholding. So what kinds of minority investments do we see that, in particular, that work well? Well, we see buy and build strategies, we see international growth strategies, we see opportunities where you can add a lot of value by changing the management, by instituting new governance. So those are the kinds of deals that we see that work in a minority setting. What kinds of deals do not work in a minority investment setting? Well, if there's significant changes to the balance sheet or changes to the P&L. So if you've got to go in and renegotiate with the banks, you probably don't want to do that as a minority investor. You need the majority to do that. If you want to go in and make significant changes to the P&L to cut costs dramatically, probably the majority owner is going to have some resistance to doing that. So certain types of deals that we would definitely do as minority investors, other types of deals that we wouldn't want to do. If we could do all majority deals, would we do it? Sure, but it's not the most important factor.
Cool, thank you. So probably because we're running out of time, I see there. It's already 28. Just if you could just in a few words tell us about how you see the outlook of your activity with the new uncertainties you're coming ahead, and how you feel minorities investments going to perform in the coming year. Any one of you, if you have.
Maybe quickly, as it was raised, sometimes in tough time, family business have a better resilience than companies which are only managed by managers, and because it takes you back to the alignment of interest. One, and two, when you do minority investments, you have less leverage. And when you have tough time, you have to reimburse your debt. And if you don't have the cash flow anymore to do that, but where I agree with what Eric said is it's not linked only to the minority, it's linked to the quality of the entrepreneurs.
Maybe I can add to that. I fully agree. I mean, in the end, I think in the next months and years, I mean, the quantity of opportunities is going to rise. That's for sure. Also, especially in the field of family-owned businesses, as all the Western countries have the same issue with demographic pyramids, and more companies are going to have to plan a company succession sooner or later. And for that, I think the quantity is going to increase. The quality, I'm not really sure about it. I think in the future, investors are going to have to look really in depth and to do more due diligence and really to have a stronger focus on strong business models with strong cash flows to really ensure that they're not buying a non-transformable company in the end. Because I'm really afraid that many of these family-owned companies are going to come too late to market, come too late to plan their succession and to start and trigger the process to do that. Regarding the debt portion, this is also something very important. I think it's not really a big issue for minority investments because you usually do not use that much debt. Family-owned businesses are even often debt adverse. So even if you start talking about acquisition financing, they might even reject. And even if it would be possible to put some acquisition financing on a transaction, you would always try to use the operating cash flows more for the internal transformation and invest within the company to get a real clear track to exit.
Okay. So just in a quick words, because we're really running out of time.
Really quick. I'm talking about the tech sector where minority investments are dominating, especially on the early stage there. I think in this sector, alpha is really generated by growth, and with innovation and technical progress, this is something you cannot stop. In difficult times, and looking ahead, I think there is a flight to quality in terms of the selection of the business models which will be funded, and so and at the same time we see a lowering of the valuations. So I think this will be very prosperous times for investors as the underlying companies are stronger, and the growth creates an alpha in itself.
Cool. So agreed. So business is here to stay. We'll be still there in a few years, and we will still make investments, trying to help strong entrepreneurs with a lot of vision, and we believe it's a very resilient asset class. So hopefully we could demonstrate that during this half an hour. So thanks for your time and your attention, and have a good afternoon.